What's going on, guys? Welcome back to another video. We have a lot of really interesting information to cover in tonight's video here. We received non-farm payroll data on Friday, which is giving us a lot of key insights into how the market is thinking about kind of the data that's going to be coming out over the next couple of months here. Now, you guys know, if you guys have been following me on Twitter, I will probably pull up the tweet at some point throughout this video here, but I've been saying that bonds were most likely going to trade lower for some time, making that call on my Twitter account, short the VIX2, the day before the FOMC meeting, and as we'll see, bonds have traded lower ever since. But the main risk that we have in markets right now is reinflation fears, because now that the Fed is starting to cut rates, the risk isn't that, oh, inflation just continues to move to the downside, because the Fed has already come out and said that they are going to be starting this cutting cycle, and we saw that first 50 basis point cut. The risk is that if inflation in all of the data surrounding it starts to reverse back to the upside, which we're going to cover and make the case for, that narrative is going to start showing up more and more, and we need to be very, very aware of that as market participants. So let's get into this video here, team. Again, if you guys do enjoy these types of videos, make sure you guys drop a like down below. It helps me out a whole lot getting this information out to as many people who actually want to have long-term success in the market and understand exactly what's happening on a day-to-day basis. But again, I gotta also give a shout out to my Discord private community members. I mean, guys, what do you expect at this point? You guys see me do this every single week, finding the best stocks in the market that are about to explode before they do. We entered DJT on Friday, rode this thing up to 19 here today. We're able to get a really, really nice scale out on this one, and I'm just holding a risk-free position here. Then those of you guys that do love day trading, with that day trading strategy, guys, you guys were able to get a nasty 1 to 4 risk to reward here to that first take profit before getting stopped at break even. If you guys are looking for that home to finally give you that success in the path to success in the market here, make sure you guys check out that link down below. You guys are going to get the watch list of stocks that are about to explode before they do, the private live streams, the pre-market plans, all the educational courses, access to the community, and special offer for you guys right now. This is really not going to last for very long, but everybody gets their first month 50% off, so it comes out up to about $1 a day for your first month. So again, you guys want to come in there, we'd love to have you, but if not, no complaining when you guys see me posting on social media all the gains that we are continuously making. Now, let's talk about this non-farm payroll data here. So when we went into Friday, we saw that the expectation is that we were going to add about 159,000 or about 140,000 jobs here. The previous data was about 159,000 job increase, and the actual number that came out was 254,000 jobs. Now, obviously, with the significant downward revisions that we've seen in the labor market data so far this year, specifically in August when we saw that giant 800,000 job downward revision, which essentially just means that they overstated the jobs numbers by 800,000 jobs, which is a very, very significant amount. My initial thought was that the jobs data was a little bit fake here, and they're probably messing with the numbers. Again, it's an election year. It's the last NFP report that's going to come out before the election. Again, you can believe the numbers or not. The bond market, though, which is interesting, is actually believing these numbers. Why? If you start to see unemployment going down, which is against what we saw out of the Fed's new summary of economic projections, where they are now expecting unemployment to climb up to 4.4, 4.5% by the end of the year, and we are currently sitting right around that 4.1 range, well, that could easily lead to more growth. Now, if you have more growth at a time where a lot of the economy is relatively fragile anyway, with so much excess capital in it, we could easily see those reinflation fears starting to move back to the upside, or really just inflation moving back to the upside, and the expectations that inflation is going to move to the upside moving up as well, which that's the important part, inflation expectations. Because think about it like this. If you're a rational thinking person and you think that the prices of goods and services are going to be more expensive in the future than they are right now, what is the most logical course of action that you're going to take in terms of the relationship between you and your employer? We are obviously going to ask for higher wages. We just saw that massive port strike where they did come to a tentative solution. They've kind of kicked the can down the road a little bit to the middle of January, but we're probably going to see things like that continue where these large groups of people are going to get together and request higher wages. Now, again, if those wages end up getting paid, these companies that are paying them are obviously going to have to increase prices in order to maintain their current margins. So that's kind of what we're looking at here out of the labor market data. But think about it like this also. The reason why the Federal Reserve would be cutting rates as aggressively as the market thought they were going to, remember, they were pricing in an ungodly amount of rate cuts again, which personally I disagreed with, and I've been sharing that view on this channel over the past couple of months here. Well, if the reason for the cuts, which this is what it is that the economic conditions are going to deteriorate, unemployment going up, growth going down, CPI, overall inflation data moving to the downside, well, then it makes sense that the Fed might want to cut. But if that's not the case, then you don't have to price in all of those rate cuts. Now, that was also showcased in the bond market here, where we were seeing people flying into these longer dated treasury securities, because if they think that the yields on these securities are going to be lower in the future than they are right now, then you might as well go out and buy them in the present in order to lock in that interest rate. That's very key. So that's kind of what we've been seeing. We've seen the pendulum swing all the way to one side, where all of these market participants are saying, oh my God, the economic conditions are deteriorating. We could be in a recession already, even though the data isn't really suggesting that. We might as well go out and buy these bonds and price in an ungodly amount of rate cuts. Now, rational market participants like you and me, and hopefully for a lot of you guys that weren't going long, what everybody else in the market wanted to, these bond ETFs like a TLT, you were able to see and understand this right here. Way too many people are bullish on bonds. This was the day before the last FOMC meeting. The market is currently pricing in about 200 basis points of cuts through Q1 of next year. In order for bonds to move higher, you need the market to price in even more cuts when the expectations are already too aggressive. TLT at big resistance as well. The long bond trade is too crowded. Be careful. And ever since then, we have seen the bond market and overall bonds just knife to the downside. Now, how does this relate back to reinflation fears? And is there anything else that we could look at to say, well, reinflation in this narrative starting to kind of become the norm and what people are going to start talking about? What else would we look for in order for that to start occurring? Energy prices. Energy is in everything. Transportation, a lot of the production of goods and services. And what have we seen out of oil recently? Oil's been aggressively moving to the upside. This is not good. We do not want to see this if we want inflation to maintain its downward trajectory at this current time. So when we think about all of this as a whole, we have non-farm payroll data saying that more people are working than the market thought. The unemployment rate is going down. What could that lead to? More economic growth in the United States. People are making more money. They're spending more money. Consumer spending goes up, and that could add upward pressure on prices. In addition, now this is a lot of this in the oil market here is going to be related to the conflict that is happening in the Middle East. So if we continue to see this happening, well, you're obviously going to see oil prices continuing to the upside, which again is going to be inflationary. Now, what I want to make clear too is that when I talk about reinflation risks, what I'm more so talking about is the narrative that the market is putting out as a whole, not necessarily the reality of what's happening, because those are most of the time two very different things, and that provides some really good opportunity for us to make money, just like in this situation here where we were looking at shorting bonds. Again, guys, in order to have long-term success in the market, you cannot just come out here and say, oh, I'm going to put my little cookie cutter setup onto the market or some magic little thing and expect to make money over time. It's not going to happen. You have to have that big picture, that overall understanding, and then identify really, really solid chart setups within that. So to kind of wrap this all up in a little bow here, we have these reinflation risks starting to emerge. Now, what could continue to happen? Well, obviously, oil could continue to go up. Bonds could continue to the downside. But the kicker here, which is interesting, and this is a point that I think not a lot of people are going to grasp at first, is that the markets don't necessarily have to come down based on this. What we've seen a lot throughout the entire year is that bad news is good news and good news is bad news. That has changed over the last month or 2 months or so. Now we are seeing good news in terms of economic data be actually good news. So If the economic data continues to come out relatively strong, especially if it relates back to the strength of the consumer and the consumer doing well, markets can actually continue to go up as economic conditions can actually get better. Because what the market is actually looking at here is not actually taking the federal funds rate back to 0%. They're looking to find wherever that neutral rate is. That's where the market wants to get to. The issue is that we just don't necessarily know what that neutral rate is. We don't want to be in a restrictive policy stance anymore, as kind of using some of the Fed terms there, but we don't necessarily want to overcook it and reignite inflation. It is all about finding that balance. But before we wrap up here, I want to bring your guys' attention to one interesting spot in the market that I think we should pay attention to. Now, the daily 10 EMA on ES here is getting tested and a little bit blown through again today, as you guys can see on the screen here. Now, in the Sunday Swings episode that I did yesterday for you guys, where we're covering and giving out for free a couple of really awesome trade setups going into every single week, I did say that it was likely that we were going to come back down and test this area. If we continue to shift down from here, I would say that it's relatively likely that the market is going to go into a little bit of a period where it's going to pull back heading into the election, and then we can kind of figure out where we want to go from there. So guys, that's really going to wrap up this video here. If you guys have any questions on anything that we covered, make sure you guys leave a comment down below. But other than that, I will see you guys in the next one. Peace.